Hello and welcome to the video. Today we're going to be looking at 3 stocks I think could potentially achieve a 50% plus growth over the next 6 to 12 months or so. All 3 are companies I currently hold in my portfolio, so my money is where my mouth is, and I believe they are all fundamentally very strong companies and they're all currently undervalued, leaving the possibility for really high levels of capital appreciation in the coming months. If you are someone looking to add greater growth prospects to your portfolio, perhaps because you are currently heavily weighted in dividend stocks, these might provide you the opportunity. I have also chosen these stocks because I believe that they have low levels of downside risk, as in my opinion, they are solid individual companies with good long-term prospects. So without any further ado, let's dive in and take a look at stock number 1, which is InMode, ticker symbol INMD. InMode is a company which provides medical equipment to both professionals and end users, mainly for minimally invasive surgeries and treatments such as contouring, skin treatments, acne, hair removal, anti-aging, you can see here, pigment and vascular issues. It's a growing market and technology has now advanced to a stage where products can be produced at a cost to target the end consumers who can use this equipment at home, as opposed to having to visit a clinic which you would have had to do previously to get the benefit of these treatments. So you can see here they've got a number of products which target all the different treatments and procedures that they do. Of course, the great benefit to producing this technology is that it now opens the market up to a much wider audience than would have previously been able to afford or use this type of technology and have these type of procedures done. And hence that drives revenue and profits of companies such as InMode. To prove this, let's dive into the Trading 212 app to have a look at their financials. So here we are inside the Trading 212 app. We are looking at InMode stock here. So to start with, let's just have a look at the charts and see what's been going on with the share price over the last few months. So you can see pre-pandemic we were around $50 per share, slightly below. We then hit March and it dropped all the way down to under $14, which would have been an absolutely fantastic buy if anyone bought the stock at those levels. It's then been rising fairly steadily for the next 3 or 4 months, peaking at roughly $35 before falling again. I added some more shares down here when it fell below $26 a share, and it's rose rapidly this week. This week it's up 20% in a week, 6% today, back up to around $34 a share. So the share price is doing well. It's still roughly $15 off its all-time high where it was at pre-pandemic levels. So I would expect it to start to creep back up towards those levels as we move towards the back end of the year. If we just move down and have a look at some of the numbers, so the first thing to note here is the PE ratio on InMode is currently 17.77. So for a growth stock, I think this is really low. When you compare it to some of the other growth stocks out there, some of which are well over 100. Some of the well-performing tech stocks, Facebook and Apple, are roughly around 30. So as growth stocks go, I think for a PE ratio, this is really low and does signal that the share price is currently undervaluing the stock. If we go down further here and go into the income statement, they haven't got the full 2020 results yet, obviously, but if we go into quarterly, you can see the total revenue in Q1 2020 was 40.44 million, which compares to 47 million in Q4 and 40 million in Q3. So the revenue hasn't dropped much from where it was in Q4, which, considering the circumstances, I think is pretty good going. If we go down here to the balance sheet, you can see it's got a very good looking balance sheet, very healthy debt to assets ratio of sub 20%, which is fantastic. Currently hold nearly £200 million worth of cash, but the most attractive thing about this stock is the lack of debt. So they've got no short-term debt at all and no long-term debt. So 0 debt on the balance sheet, which is extremely rare and very attractive. Cash flow steadily increasing, so all in all, looking very healthy. Yes, it's been affected by the pandemic, which has probably halted their growth or minimised their growth, but they've maintained their revenue levels, and I'm sure we'll be looking to kick on and start to grow those revenues again towards the back end of the year. So as a stock, I see this as being very undervalued. If you consider it was at $50 pre-pandemic, it's maintained its revenues, you'd expect it to still be at that level. So in my opinion, this is a really good buy, despite the fact it's increased nearly 20% in the week. It may pull back a little bit from here, and if you can get it anywhere around the $30 mark, in my opinion, this is a really good buy. My number 2 pick is Dart Group PLC. For those that don't know, Dart Group is the parent company of Jet2, Jet2 Holidays. They were, if we go in here, you can see that they did previously own a distribution company, which they recently sold, which they've announced here. So distribution logistics business called Fowler Welsh, but they've recently sold that to Kalina Group for around £100 million. So I think the reason they were called Dark Group was because there was a couple of different strands to the business, but now they've sold off the distribution side. I don't see they should really be renaming themselves Jet2 Group, in my opinion, just to avoid confusion and to help everyone understand what the primary business is. So Dark Group then is obviously a travel company. It's a leisure business specialising in flights and holidays, and it's obviously a sector that's been absolutely battered over the last 3 to 4 months. With the pandemic grounding flights and stopping people travelling, airline companies have been one of the worst affected sectors. So of course the share price has taken a battering. And some people might be thinking that this is a risky stock pick because the share price of these companies might never recover. But I don't think that would be the case with Dark Group, and there are a few good reasons why. Firstly, their balance sheet, as we will look at when we go into the app, is much stronger than the vast majority of their competitors. They carry very low debt. They've also been widely credited for being one of, if not the best, airline company for paying refunds for holidays that haven't taken place. I know a lot of the other guys, EasyJet, Ryanair, are coming under a lot of pressure for not paying customers refunds, and it's really starting to weigh on their customer loyalty and brand loyalty. That is one of the things I think Jet2 and Dark Group will really benefit from. They've been really good in paying refunds. I think they'll win a lot of customer loyalty, but they'll also win a lot of customers off some of the other budget airlines which haven't been doing anywhere near as good a job as they have. And finally, and probably most importantly, Dark Group have reported really strong or really encouraging numbers of bookings for next year, which is really helping their cash flow, and it's demonstrating that there is still a market, there is still people that want to go on holiday. I think a lot of people are booked for the back end of next year and early next year to try and get away, having missed their summer holiday. So really encouraging sign for Dark Group, Jet2 and the travel industry as a whole. So now let's dive into the app and have a look at some of the company financials and the trends. So this is Dark Group in the Trading 212 app. As you can see, they've had a big fall from their pre-pandemic levels of nearly 2,000 pence, so £20 a share. They fell all the way down to what was close to 300 pence a share, so only £3, so a massive fall. It's been trying to recover since. It's fallen back a few times, peaked at around 1,000 pence, so £10 a share. Again, fell back. I added a few more shares here. My average position, as you can see, is roughly 571 pence per share, so £5.70. At the moment it's sitting at just over 700 pence per share, although I do expect it to start to crawl back up to where it was before. If we go down and have a look at some of the financial information, you can see the PE ratio is only 5, which is really, really low. If we go down here to the income statement, the most impressive thing here is that the 2020 revenue is actually higher than 2019 so far. So they've actually increased their revenue despite what's been going on with the pandemic. Their profit margin has shrunk a little bit, but as you'd expect, given what's going on. If we look here, you can see 3.38 billion for 2020, 3.14 billion for 2019, 2.38. So they're growing consistently, and they grow despite the headwinds, which is really impressive. Balance sheet, which I mentioned before, is not as good as maybe what you'd expect in the tech industry, but in terms of a leisure industry, especially an airline, it's really good, and when you compare it to some of their competitors, it's really impressive. So they hold 1.4 billion of cash and short-term investments. I would expect that to drop a little bit next year, as I'm sure they're burning through some cash at the moment. The debt, again, is the important thing. They only have £977 million worth of debt, so they hold more cash than they do debt, so they could pay that off if they needed to, which is really attractive. If you look at a lot of other airlines, you'll see that they carry an awful lot of debt, which really increases the risk factor associated with owning them. So in summary, I think if you could buy the stock even at this 700 pence level, I think by the end of the year you'd be looking at a 30 to 40% gain, because I do think it'll get up to over that £10 a share mark, maybe up to £11-12 a share. So yes, it carries some more risk just by the nature of the industry it's in, but I really do think it's a risk worth taking, in my opinion, just looking at the company as a whole, how they've handled this pandemic, and their balance sheet, and also their prospects for coming out the other side. My final pick is Taylor Wimpey, which is a UK house builder and is a stock which I've been building my position in over the last couple of weeks or so. Again, this stock has fallen hard over the last few months and has slowly been creeping back up, but is another stock that I see having good long-term prospects. There is still a demand-supply imbalance for UK housing, which isn't going anywhere despite the pandemic. There also continues to be government incentives and subsidies to drive business for house builders, such as the Help to Buy scheme, which you can see on their website here, and more recently the cut in stamp duty land tax, which you see here, which was a response from the government following the pandemic just to try and encourage the market to get back on its feet and to try and encourage people to get back into the housing market, to make those purchases that they may have been thinking of, and to give the industry a real boost. So now let's go back into the Trading 212 app, have a look at the charts and have a look at some of the financials. So this is the chart for Taylor Wimpey. So as you can see, they're well off their all-time highs of 232, which was set in February this year. They've been bobbing around sort of the 200 pence mark and down to sort of 150, and been trading in that range for the last 5 years or so. So quite a long period. It looked like they were just sort of really starting to kick on before the pandemic. They've fallen all the way back, so they've sort of settled between sort of 140 and 150 pence so far. So they're roughly 50% down from their all-time highs. If we go down, you can see here that my position is average price 141. So as I said, I've been building a position recently. I've been gradually buying shares in batches of 10, 20 and 30. The cheapest price I bought was roughly 137, 136. The most expensive is 145, which it was a few days ago. So I've averaged out roughly where the price is sitting right now. So we go down here, you can see the PE ratio, very sensible at 7. The dividend yield, just short of 3, although I believe that's been suspended for the time being. I'm sure that'll start being paid again, probably late this year, early next year. In terms of the revenue, it's been pretty stable with small amounts of growth. Profit margin is healthy and a consistent profit as well, which is what you want to see. Balance sheet, again, very good. Debt to assets ratio is low. We go in here, you can see they have 0 short-term debt and only £100 million of long-term debt, and 630 million of cash and short-term investments. So they can pay off that debt very quickly. The other thing to note, Taylor Wimpey, is they have recently just undertaken a capital raise, which was designed to raise some capital to fund some new land acquisitions. They feel pricing has reduced slightly given what's going on, and it's allowed them an opportunity to buy some land at slightly cheaper prices to obviously build out some new schemes, new housing developments. Cash flow stable, so pretty happy with the financials. As you can see, the revenues remain pretty stable, but the share price is down on its all-time highs. So I am hopeful that share price will start to creep back up towards the 200 pence mark, and hopefully over towards 225, 250, and set all new time highs. So from the share prices that currently, I can see it achieving 30, 40, 50, maybe more % growth over the next year to 18 months or so. So as an investment, I think it looks really attractive at this sort of level, in my opinion. And that's when considering some of the incentives and initiatives the government is providing alongside the ongoing supply-demand imbalance in the UK housing market. So I think those factors are only going to drive revenues and profits going into the future. So hopefully that share price will go with it. So that's just about it for the video today. There's 3 stocks there which I believe have got really good growth potential over the next 6 to 12 months and could potentially provide returns of anywhere of 50% upwards. Let me know your thoughts, if you agree, if you disagree, if you hold any of these, what prices you hold them at. If you enjoyed the video or took some value from it, please hit that like button or click that subscribe button. Your support will be greatly appreciated in supporting the channel. Otherwise, I'll see you in the next one.